Welcome to this explainer. Today, we're completely skipping the toxic crypto hype and all those wild headlines. Instead, we're going to objectively evaluate how blending the hard code of computer science with the rigorous principles of economics can actually solve massive, real-world financial problems.
Okay, let's dive into this. Our guiding principle today comes from MIT's professor Robert M. Townsend. We're establishing an objective middle ground here. We aren't here to champion Bitcoin, and we aren't here to tear it down either. We're putting ideological positions entirely aside so we can focus strictly on how these underlying technologies act as practical tools for policy designers to implement actual world-changing use cases.
To get there, we really need to translate between two very different worlds. On one hand, you have the buzzwords of computer science, stuff like blockchain, tokenization, algorithms. And on the other, you've got the bedrock of economics, contract theory, mechanism design, monetary theory. What we're doing today is exploring how the technological code of computer science perfectly pairs with the economic concepts of human incentives. It's like a giant puzzle coming together.
So, here's our roadmap for this explainer. First, econ meets computer science. Then we'll explore the holy trinity of this tech: distributed ledgers, smart contracts, and encryption. And finally, we'll see how they all combine into upgrading the financial system.
All right, part one, econ meets computer science, finding the objective middle ground. Moving right along to part two, distributed ledgers, the foundation of financial plumbing.
You know, in economics, there's a key construct known as the central planner. Basically, a theoretical entity that coordinates resources efficiently. Well, these technologies allow us to abstract away that centralized planner into concretely deployed, decentralized mechanisms, specifically shared databases called distributed ledgers. But we have to be realistic here. Perfection is mathematically impossible. Just like in physical village economies or the US economy, the CAP theorem proves that in distributed systems, structural trade-offs are unavoidable. You literally cannot be perfectly consistent, always available, and partition-tolerant all at the same time. Choices just have to be made.
Think about it. If everyone just carries around their own digital balances, what happens when someone buys more than they sell? Without a big-picture community perspective, they inevitably show up unable to balance their accounts and they just default. In our legacy financial systems, we rely on end-of-day settlements or basic overdraft accounts. But for a decentralized system to actually function efficiently without crashing, it requires an enormous amount of liquidity. To fix this, we need a lot more than just a shared database.
Which brings us to part three, smart contracts, programmable money, and the automators.
$10 trillion. I mean, that's $10,000 billion. I really want to announce the staggering figure to emphasize the massive real-world scale of the problem hiding inside our financial plumbing right now. This is where we shift our focus away from static ledgers that just record history and move toward dynamic, programmable, tokenized assets that can act on their own.
So the crucial point is this. In our legacy systems, trillions of dollars in US Treasury trades are agreed to, but ultimately fail to execute. These are known as massive trade fails. Because of delayed end-of-day settlements, or sometimes settlements days later, the person with the money or the person with the asset simply doesn't show up when the time comes.
And why does this happen? Well, imagine this chaotic chain. Trader A owes 2 units to Trader B. Trader B owes 2 to C, and then C owes 1 unit back to A. Who pays who first? B needs A's payment to pay C, right? But nobody has full visibility of this interconnected network. Individual nodes are totally blind to the overall structure. It's an absolute combinatorial nightmare to figure out the correct, judicious ordering of payments to clear these obligations without accidentally triggering a default.
This is exactly where the solution comes in. Compared to legacy systems with static balances and uncoordinated money that cause crashes, smart contracts offer a dynamic, multi-agent ledger. They provide immediate atomic settlement, meaning the trade either happens completely or literally not at all. An automated, multilateral smart contract can view the entire network, identify closed cycles, and automatically execute the precise sequence of offsets and safe liquidity injections required to clear the trades instantly.
Now for part four, encryption, the trust layer.
So taking dynamic, automated contracts and running them on a highly visible, shared ledger obviously requires deep layers of trust, privacy, and security. But the concept of encryption actually isn't new. It goes back thousands of years to Mesopotamia.
If you wanted to securely ship goods, you created physical tokens representing the invoice. You'd place them inside a hollow clay envelope, bake it rock hard, and draw pictures of the contents on the outside. The recipient could break it open to verify exactly what was inside, guaranteeing the shipper didn't steal anything along the way.
And this brilliantly illustrates how those ancient clay envelopes were essentially the world's very first public and private keys. They allowed the receiver to authenticate the sender, confirm the origin, and mathematically guarantee the contents hadn't been tampered with. In computer science, protecting a network from bad actors is famously framed as the Byzantine general's problem. Basically, how computers coordinate over a failure-prone network when some participants might be acting maliciously. But when we look at this through the lens of economics, we uncover an incredible insight. A rogue computer node failing a protocol is really just a rational human actor responding to misaligned incentives. The CS code and the economics are trying to solve the exact same human behaviors.
To solve this today, we use modern cryptographic miracles. We have tools like fully homomorphic encryption, which lets us perform accurate math on encrypted data without ever seeing the raw inputs. We have multi-party computation, and we have zero-knowledge proofs, which let you prove something is true without ever revealing the underlying data itself. These tools are absolutely crucial because they allow agents to intersect supply and demand schedules, like in encrypted auctions or insurance payouts, without ever revealing their private balance sheets to a corruptible third party.
Finally, Part 5, Upgrading the Financial System, Achieving the Walrasian Outcome. Let's bring all these pillars together.
Now, what's really interesting about this slide is the stark contrast and how we manage systemic risk when we combine ledgers, contracts, and encryption. Modern policymakers often operate defensively under a contagion model. They want to limit and restrict markets to prevent the spread of damage. But the economic risk-sharing perspective is the exact opposite. By utilizing blockchain technology securely, the objective goal is to safely increase market clusters, expanding connections to optimally inject liquidity to key players, which actually maximizes stability for everyone.
And when this is perfectly optimized, we achieve what's called the Walrasian outcome, an ideal, economically efficient balance. Ongoing research shows that by merging strategic market games with decentralized exchanges, like SpeedX for example, automated algorithms can achieve this state. Instead of traders guessing and causing chaos, decentralized algorithms successfully compute the ideal mathematical equilibrium, optimizing prices and supply without the endless guesswork of legacy trading.
So what does this all mean for us? We've seen how economics and computer science beautifully blend together to move us away from hype and toward true mathematical efficiency. If our global financial plumbing was completely upgraded, if it was fully programmable, instantly settled, without a single trade fail, and perfectly encrypted to protect your privacy, how would that fundamentally change your daily relationship with money? And honestly, more importantly, your relationship with trust? Thank you so much for exploring this objective middle ground with me on today's Explainer. Keep learning, and I'll catch you next time.